17.
Listen, this is only a theoretical lecture, very simple introduction. We are not going to do anything on that, but this is very important basics. The basic concept of consolidation, how consolidation will work. I will give a simple example. You know Oman International Bank, once it was there,
Yeah.
is that OIB was there, is it right? You take Bank Muscat also, is it right? You take Bank Muscat also. OIB was there. OIB was there. It has been taken over by whom? It has been taken over by HSBC.
Yes.
Is right? It has been taken over by Sohar International. Okay, it has been taken over by Sohar International as such. Okay, over a period of time. Now what happens? Assalamu alaikum Hussein, how are you? Assalamu alaikum Hussein. Fine. Now, coming back to this, Oman International Bank was there. It has been taken over by HSBC. Is it? It has been taken over by Sohar International. If you take the history of Bank Muscat also, what they have done, they have acquired. Is that they are late entrant. They are very late entry in the banking industry. But what they have done, they have acquired other banks. Okay, they have acquired other banks, and slowly they have become a major bank. There are so many advantages of acquisitions. Okay, there is so many advantages of acquisition. Now, when HSBC, I am giving you a complete picture of this lecture. Very simple, very easy. Is that very? When HSBC acquired the OIB, okay, HSBC is a parent company. OIB is a subsidiary company. See, if you take into consideration the role of HSBC has only at that time, very clearly it is having 20 banks, and OIB is having more than 200 plus branches. Okay, 200 plus branches. But what happens because of it is not only the shares that matters. It also matters with respect to directors. Is it? It matters about that. But subsequently, that's the next stage. Means there are so many ways of acquiring the companies. You have the parent company, you have the subsidiary company. Parent company and subsidiary company is otherwise called as a non-controlling interest. Non-controlling interest. This is the basic foundation of the financial reporting. It is there in F3, it is there in F7, it will be there in SBR also. 3 levels are there. Okay, 3 levels you will have the consolidation. Now we are doing the intermediate level, between F3 and SBR, strategic business reporting. When we are talking about it is a non-control. Now what happens? Keep it in mind. I'm giving you an example of Sohar International and HSBC. When Sohar International acquired HSBC, okay, HSBC has a different balance sheet, financial statement. Sohar International will have a different. Now the moment they acquire, what will happen? There will be a payment. That payment is going to be called as a purchase consideration. Is it? That payment is called as a purchase consideration. Now, when they are acquiring, they will have different independent financial. I'm not saying different, independent financial statement. But once there is a acquisition, now HSBC is not anywhere in the picture as such. Is that? HSBC is not in picture. What is there in the picture? It is only the Sohar International. The balance sheets will be consolidated. Means whatever the assets, is it that? Whatever the assets, whatever the liabilities are there, that will be merged with the parent company. Is that? That will be merged by the parent company. Now, when you are merging with the parent company, what is the procedures they have to do? Is that? What are the procedures? What are the accounting calculations they will do? That is the only aspect of the understanding this. It's not like that. It's not one time we are going to say that it will happen in one step. No, you will have so many things. Previously, Sohar International will have some transactions with HSBC. But what happens? Those transactions will be eliminated. Okay, those transactions we call it as intercompany transactions. Is it intercompany transactions? Intercompany profits. Is it intercompany profits will be automatically what will happen? It will get eliminated. Now, what is the most important thing is when a parent company purchases a subsidiary company, the subsidiary company will make a valuation. Is it? It have a valuation. Valuation is based on the market price. Market price per share. They will negotiate. Is that they will negotiate? They will have all the procedures. Now, when they are talking about the market price, definitely what will happen? They will take into consideration the market price as such. That is the purchase consideration. Is it? That is the purchase consideration. From the purchase consideration, they will take into consideration what are the things, the assets of the subsidiary. Okay, the assets of the subsidiary they will take. Is it? They will take the what are the controlling interest of the subsidiary. Okay, they will say subsidiary controlling interest. Now, what happens when when they are giving a market price? Definitely market price minus book value. In simple words, okay, market value minus book value. Definitely they will get plus or they will get minus. If they get plus, definitely they are paying more. Is that they are paying more than the value of the assets. It is called as a goodwill. Is it right? It is called as a goodwill. Is it? If it are paying more, if sometimes it will pay less also. Is it right? It will pay less also. Is it? We will not say negative goodwill. Is it right? We will not say negative goodwill. Okay. What we are going? We are going first and foremost. What are the steps? Steps are very easy. The steps is for every step they will give you marks. Okay. What happens? The first stage is we have to know the structure. Is that we have to know the structure. They will say what is the share of parent company, what is the share of subsidiary company. The second thing is we are talking about what are the net assets. Is it? What are the net assets of the subsidiary? Is it? Net assets. What will happen? See, assume. Now if assume that they are purchasing the company, the subsidiary on 31st of March 2024. Is it? They are purchasing on 2000. Definitely. You have to divide it. Okay. You have to divide it. Whatever the profits which is before 31st March is called as a post-acquisition profits. Whatever the profits, sorry, 1 minute. What are the profits you are going to have before 31st March is the pre-acquisition profits. And whatever the profits you are going to have after 31st March is called as a post-acquisition profits. Is that what are the pre-acquisition and post? Very simple. Wherever there is a doubt, just let me know. I will be in a position to explain you in detail. Is it? Pre-acquisition is before acquisition. They have mentioned very clearly. This is the date on which you are going to acquire it. Okay? We are only making a point. Keep it in mind. We are only doing the calculations for subsidiary company. We will not touch anything. Parent company will remain same. They will not. Parent company, maybe you will add the share of all the subsidiary companies wherever it is applicable. Profits will be added if there is any intercompany transactions, any unrealized profits, only be added. But what happens? The calculations of subsidiary company will be taken care of. We are going to do only on the subsidiary company calculation. Now, when we do the things, there will be a pre-acquisition profits and post-acquisition profit. In the pre-acquisition profits and post-acquisition profits, we will make it very clear. In the beginning, they say that what is the share of a parent company and what is the share of a subsidiary company. Now, when we are saying when share of the parent company, we will have a control. How you determine control when you are talking about the things? When you are talking about the control will have more than 51% of the equity capital. You are purchasing more than 51% of the equity. Control will be there in terms of directors also. Majority of directors of the sub company will be held by the parent company. The decision making process. The decision making process will be with the parent company as such. Okay, that's what we are saying. Now 51%. Here what they will do, 51% will be the parent and 49% will be the subsidiary. If it is less than 49%, we call it as a subsidiary, and there are various words we use. Okay, either we call it as a subsidiary, is it right? Subsidiary. We call it as a non-controlling interest. Is it? We are non-controlling interest, or we also NCI. Okay, NCI, or we also call it as a minority interest. But as per the IFRS, is it? As per the IFRS, as per the standard, we call it as a NCI. Is it? We call it as a NCI. That's all we are doing. They will give you two different balance sheets. We will do the calculations with respect to the subsidiary balance financial statements, and subsequently we will merge the subsidiary balance sheet financial statements, including profit and loss account. Profit and loss account, we are just restricted to, keep my word, we are only restricted to a basic calculations. Here we are not doing any advanced calculation. A basic calculations of the subsidiary company by merging the financial statements of subsidiary company with the parent company. When we say merging of financial statements, it means profit and loss account and balance sheet. In the examination, they will only give one. Okay, they only give one. Income statement, both are easy. I'm not saying as well, both are relatively simple. It's only plus or minus we have to do. Is that? This is what the consolidation talks about. What it says, describe the concept of a group as a single economic entity. Are you clear about this?
Yes, doctor.
Okay. Now, define the single economic. Explain the definition. What is the subsidiary according to the IFRS 10? What is the meaning of the subsidiary? What are the IFRS accounting standards we are going to use? Under what circumstances when a group may claim exemptions? Sometimes we will say that it is not required. What are the rules? We explain why directors may not wish to consolidate. Fine. These are more technical aspects. Okay. And wherever is the focus, I will make it a point. Is that use of conterminous year end. Sometimes what will happen? Yesterday we have done one example that two financial statements are there. Is that? Yesterday we have done one question, if you remember, that if there are two different companies, I told you example, Tesla is there. Tesla has acquired Twitter and it converted to X. There are two different companies. There is no restriction that you have to be in the motor industry only. Samsung is there. Samsung is varied business. Okay, we are thinking that Samsung is only with respect to the gadgets. Gadgets is one of the smallest unit of the Samsung. They are in construction, they are in lifts, they are in every high-end machinery. They are in various aspects. There is no hard and fast rule that you have to have a similar type of business. Any business across the industry you can acquire. There is no restriction. Now, what happened? The only condition is whenever there is a consolidation, both the financial statements should have the same reporting date. Is it right? That is very important. Yesterday we have done, I told you that I will explain you later. Is it? The same reporting. You can, one company, one firm is preparing financial statements on 31st, another one is preparing financial statements on 31st March. It will not work. Okay? It will not work. You will have the similar date as such. Fine. This is what we are talking about the things. Fine. Now, there is a group definition. What is the parent? What is the subsidiary? What is single economic means nothing but we are consolidating. Is that consolidating the into one parent and subsidiary? We will merge. Is it right? We will merge the financial statements of subsidiary with the parent company. Some exclusions from consolidations and what are the rules of consolidation. Is it? Now, already I have explained completely. The entire chapter I have explained you, more or less. Okay, it is a 50%. You should have own more than 50%. Once you own more than 50%, you will get the control. The first company is called as a parent company. The second one is going to be called a subsidiary company. Is it? P will manage, parent will manage subsidiary. Is it? And if it merely a department of P rather than a separate. It is only a part of its control. Okay, it's not a separate business. Okay, once it is merged, in strict legal terms, remain distinct, but economic substance they can be recorded as a single unit. Legal terms, they are very unique. Is it? Legal terms, they are very unique. They say that as what is my share. When you are saying legal term, you are talking about the what is the share of the parent company and what is the share of the subsidiary. Is it? This is where we are making. I gave you the simplest example. So you take Sohar International and HSBC. Is it? Sohar International acquired. Sohar International is the parent company, HSBC is with the subsidiary company. You are talking about Tesla and the X. Okay? You are talking about the Facebook has acquired WhatsApp. Then they acquired Instagram. Is it right? These are all subsidiaries. What will happen? Is it? Tata acquired Jaguar. Is it? Tata acquired Jaguar. Is it? Land Rover. This is the way that you are talking about the acquisitions. In the world, acquisitions will happen very, very aggressively because whenever there is acquisition, what will happen? You will have a economies. Okay, you will have a economies of scale. You have economics of scope, and you have a economics of experience. You get why there is a consolidation. You can reach a wider market if you are having the you have the merger. Is a Sohar International can reach a wider market. You will get the customers, you will get the network. That I told you. OIB has having 200 plus. HSBC is having only 20 plus. When they merged, HSBC had a wide area of network under its control. But for that they will pay. It will not come just a free of cost. Okay, that the additional amount which they are going to pay, that additional amount is going to be called as goodwill, and it will be calculated. Now we have heard about goodwill. But what is the goodwill in ultimate terms? Goodwill is nothing but the amount what we are going to pay over a period of time whenever there is acquisition. In IAS 38, intangible assets. Is it? These are just I'm focusing. intangible asset. What the rule intangible asset? Intangible asset that it should be acquired. Goodwill has to be acquired. As simple as that. If goodwill is acquired, means you are paying, then only it is going to be recognized. If the goodwill is internally generated, is it? If the goodwill is internally generated, it is not recognized. This is one of the criteria of IAS 38. Fine. Now, coming back to this, they gave about what is the group concept, how they are talking about the voting rights, all those things. Is it? Now, this is the structure. They will give you 2 marks for this. 2 marks. Now you can understand how important it is. You have to mention, they will, in the question they will say that the P, most of the time they will say P, parent company, subsidiary company, P and S. Okay, they say that P acquired 70% of the shares of S Limited. Then you have to make, when they have acquired 70 and 30. They will give you the date also when they have acquired. We have to mention this. Is that we are not talking about like this. We don't say that we have to put in circle all those things. We have to mention what is the, like this. P parent is 70%, subsidiary is 30%. Yes, 60%, 40%, 65%, 35%, whatever is given in the question, we have to follow. Okay. P controls S, therefore P is the individual, S is P control S. That is the reason they form a single economic entity and it is called as a group. Is it fine? Now, they mention all the things, how we are going to work with the consolidated financial statements as a single entity. Is it? What is the group financial? We have to prepare a statement of financial position. We will prepare statement of financial position. We are talking in terms of statement of profit and loss account and comprehensive income for that entity. Is it? Statement of, fine, these are the, what they say, see what they are saying. Note that consolidated statement of cash flow or outside the syllabus of FR. Is it right? Means they will not ask the cash flow. They will ask financial statements and income statement. Is it? There are 3 IFRS. IFRS 3 business combination, IFRS 3 consolidated financial statement and investment in associates. Just I want to make a point that the rules are there. Is that if it is more than 51%, okay, it is more than 51%, you will have the relationship between parent and subsidiary. Sometimes what will happen, greater than 20% but less than 49%, then it is going to be called as an associate. If it is less than 20%, then it is going to be called as a only investments. It is only investments. Simple concept, very simple. See, if you are really serious about ACCA, very simple. If you are in here, we are just covering the intermediate of concept. Okay, SBR totally they will give 50 marks question on this. 50 marks question. Then yes, you can imagine how important it will be. Is it right? Now IFRS 12, disclosure of interest in other entities, not examinable. They have mentioned very clearly what they will what they will examine and what they will not examine. Is that they have given you a definition? Is it right? An entity that controls one or more entity. An entity is controlled by another entity. Is a subsidiary. Control of the investor. Investor controls an investee when is exposed and has rights. Variable returns. Variable returns means profits or losses. Very clearly, there is no second thought. Is that involved in the investment and ability to affect returns through power over the investee. Is that? Now, how it is, how control, how we are going to talk about the control, the sole basis for consolidation. You have the power over the subsidiary investee. You have exposure of variable returns, is that, for its involvement with the investee. The ability to use power over its investee to affect the amount of returns. Variable returns, okay? To invest power means in terms of board of directors, in terms of you have, see what will happen. Assume if you are having 13 board of directors, is that, if one company, one representative is having maximum 3 directors, is that, 3 directors, then they will have control over the thing. It's not like that you should have 7, then only you will have the control. Is that, if nowadays, if you take into consideration most of the investors, what will happen, if you take most of the investors, they say that the major investor will have a 10%. Is that, you have a 10% only. But when you have a 10%, you are the major shareholders. All other shareholders individually, they will have less than 10%. Is it? They have a less than 10%. Means definitely you have the influence. This happens in every other company. You take it. We'll say that yes, it is X company is owned by this one. How much is owning? He's owning maximum 12%, 13%, 17%. Is that? It's a widespread. That's what we are talking about, the control. Okay. Next. Are you clear about this?
Yeah, doctor.
Okay. All the things. Exercise majority of the voting rights. You have a contractual agreement of more than 50% of the voting shares. Potential voting rights means you will have the share options or convertible loans. Again, we are talking in terms of what they will not ask, but I'm giving you a reference. Okay, they will not ask. They'll talk about share options and convertible loans. Is that sometimes there is exemptions for group financial statements. Read it. Okay, it will not be assessed, but read it. Okay, when we are not going to have the consolidation. In some cases, the rule is the IAS 27. You may not heard about this IAS 27. Very rarely we will cover. Is that separate financial statements? Even they have a group entity. Is that when exemptions of preparation of is permitted, IAS 27 separate financial requires that the following disclosures are made. Is that disclosures are made. Fine. IFRS 10, IFRA, IAS 27, subsidiaries held for sale. No, it's fine. Okay. Uniform accounting policies. Fine. Are you clear about this?
Yes, doctor.
Okay. Are you clear about this? Next. Yeah. Coming back, that is all, that much is there only in this lecture. Okay. That much there is there only in this lecture. They have multiple choice questions. Okay. Now, what they say, which of the following definitions is not included within the definition of IFRS 10? Is it? What is there? We have done a little bit early here. Is it right? They have mentioned IFRS 10. Where is IFRS 10? Here they have mentioned power over the investee. Is that power over the investee? Is it exposure of rights? Is it exposure of rights and ability to invest? Now you see the question, what is there?
Not included. Which is not included?
Yeah, which is not included.
C. Yeah, C.
Having the having power over the investor, exposure to
Yeah.
variable return, having the ability to use power, is it? This is not
Mm.
included. Is
Yeah.
it? Which of the four is unlikely to represent control over an investor? Unlikely to represent. Is it right? Owning 55% to elect four of, see, I told you, if you are having more
Mm.
number of percentage of investment and you have majority of directors, it is it is likely to represent control, likely to represent. Owning 51%, but Constitution requires that decisions need anonymous consent of director. You have investment 51%, but you don't have control. Is that you don't have anonymous means you have unknown people, consent of stakeholders. Then we can have the control. We will see having control exercisable option, which would take the shareholding of the company to 50. You have the currently exercisable options. You are not talking about the future, we are talking about the current. More than 50% it is going to be there. Owning 40% share but having the majority of voting rights. You are having a lesser percentage, but you have the voting rights are there. Majority of voting rights. Definitely then it will represent. Is right? It is likely that this is also likely, this is also likely, and this is also likely.
B, which okay, B unlikely.
Okay, the B is
Yeah.
which of the following not a condition? Is it not a which must be met for the parent to be exempt from producing activities? Is it? The activities of subsidiary are significantly different. Yesterday we have covered the same similar question in the mock exam. Is that similar question? The activities of the subsidiary are significantly different to the rest of the group and to consolidate them would prejudice means precondition of a overall group condition. See, whether they are significantly different or they are not different doesn't matter. Doesn't matter. There is no condition that you are in the automobile, you have to acquire another automobile only. You are in the banking, you have to acquire another banking only. There is no precondition. The ultimate parent company produces consolidated financial statements. It is the parent company will prepares the financial companies as per IFRS. Is it? Is it? Which is not a condition. Is it? This is a condition. Is it? This is the condition. The parent debt or equity instruments are not traded in the, yes, parent, I told you, the parent company will not touch anything for the parent company. Okay? Parent company debt and instruments are not traded. Okay? They only subsidiary company will be traded. Is that the parent itself is a wholly owned subsidiary. The parent itself or a partially owned subsidiary whose owners do not object to the parent not producing consolidated financial statement. The parent is itself is a wholly owned subsidiary. Parent owns itself. Again, we could not say that. See, what is which is not a condition. Is it? There is no condition that these are all conditions. Okay, you have to produce a consolidated statement. You should not be. It should not be traded in the public market. You have to. It is a condition that it's itself is a subsidiary, and you should not object of producing consolidated. These are the conditions. But it's not a condition that you have to have significantly different the rest of the groups. Is that you will you can you if you are in tourism, hospitality industry,
Yeah.
you can buy oil industry, oil company. If you are in the oil company, you can buy hospital also. That's a group. Is it right? If you take the group as such, is that if you take the group, is it Al Futtaim group is there, UAE, is it Al Futtaim group? They are in across all the businesses. They are in the across all the businesses. There is no strict condition that you have to. You take here also. Some most of the companies, they are in tourism, they are in construction, they are in engineering, they are in oil-based sector, they are in mining. Is it? They have holding companies. Is it? If you take into consideration OHI, is it? It's a holding company. Means you are having a. Then they will say that it is going to be called as a group. Are you clear about this?
Doctor, I have a question, doctor.
Tell me.
Yeah. Doctor, if we are owning company, like as you said, we have a share like a 51%. All right. But the activity which we are controlling, it's different than our activity. So how we will control it? We will decide who will lead it off or something like this?
See, you are the owner, is it right? You will appoint directors. You see, now I will come to that. Most of the owners,
Yeah.
is it right? Most of the owners are anywhere in the picture? No. Who will decide? You will have the board of directors.
Yes.
Is that owners? See, owners are different. That is the reason. When you are talking about the thing, there is a agency cost. The first thing what we are learning in financial accounting is agency cost. Owners will be different and the management is different. We are least concerned. You are thinking that people are there. I will say Al Futtaim group. They are business people. Is that you will come across so many cases. You come across so many cases. You take Majan College. I tell you in the example. It has been owned by a Kuwaiti group. See, they are in different business. They want to own an education industry. They will own. That's all. Today they will own, they will sell it. See, if you take a simple example of Majan College, it has been changed ownership so many times, multiple times for the last 20 years. Is that? You will own, you will see there is a potential for growth, you will make profits, you will earn, get your returns, you will sell it off. There is no condition, that is the reason. There is no condition that the activities of the subsidiary are significantly different to the rest of the extreme cases. You take Tesla, you take Twitter. See the thing, extreme. There is nothing like that. You know that Elon Musk is having any thing on technology. No, he will appoint people and he will get the things done.
Yeah.
Okay.
Understood. Yeah.
Fine. Now, which of the following statements? Are you okay with Hussein and Sumayya?
Yeah, Doctor.
Yeah. Which of the following statements regarding consolidated statements is correct? For consolidation, it may be accepted to use financial statements of the subsidiary if the year end differs from the parent by 2 months. It is somewhere. It is given in the statements. Okay. Somewhere it has been given. We have not covered. This is the. If we have missed something, it will see the thing. What the directors of parent company may not wish to consolidate due to poor performance, poor financial position, differing activities of the subsidiary from the rest of the group. This is for question number 3. The reasons are not permitted. Is it? Next. What they are saying, why they what is there? Which of the following statements are consolidation statement, consolidated financial statements is correct? Consolidated financial statements requirements of consolidation, definition. What is the option they gave you? They gave us for consolidation, all companies within them must have the same year end. Or for consolidation, all companies within the group must have same year end. All companies with the group must have the same accounting policies in their individual
It's in the,
financial statement. Only
I think in
100%.
the
Pardon?
page number 419, I think so.
419.
We can refer. Yeah. Consolidated financial statement. Up. Yeah. Yeah.
The purpose is to present about company undertaking as a single unit, economic control by the group, show obligation, show the results in the group achieve its resources.
Here down, consolidate financial statements under the single entity concept. Yes.
Through that, it concentrates on the resources that intergroup transfer will be removed, no income, no. Are prepared by replacing cost of investment fine, but not controlling interest. Business, no. The IFRS 10, where is IFRS 10? Somewhere it has been mentioned, no?
Yeah.
Here, IFRS 10.
527.
Is required to prepare consolidated statements, okay? When the parent has control over subsidiary, is just one fine, okay. If IFRS stands adopt principle based, fine. If IFRS states investors should periodically consider exercise of majority of shares, contractual arrangement, one. A potential buyers, one owned by partially the parent has its financial statements. Any circumstance excluded, however, they may specific said that merit particular has a current investment does not therefore and no subsidiary held for sale. What it says, fine, here it is there, now somewhere it is just 1 minute. If it is impractical to so, IFRS 10 states that where the reporting date of the parent is different from the subsidiary, should prepare additional financial statements same day of the parent unless it is impractical to do so. Is it right? It may be accepted to use financial statement subsidiary if the year end differs parent by 2 months. For consolidation, all companies within the group must have the same year end. That is, you should have the same year end. All companies within must have the same accounting policies. If the individual financial statement, only 100% subsidiary needs 100% subsidiaries needs to be consolidated. Is it? Somewhere there is a doubt here. Okay. We have to give the we have to get the evidence for that. IFRS 10 allows use of subsidiary financial statements made up to date not more than 3 months earlier than report with due adjustments, significant transactions or otherwise. Is it? We can put like this here. Is it right? We can put this on here. The more we will cover, somewhere we'll get more clarification. Is it okay? All three are correct. Okay, these three are, see, these three. Which of the following regarding consolidation statement is correct? For consolidation, all companies we must have. They should not. For all companies within the group must have same year end. All companies with them must have the same accounting policy. They have the different year ends, but when they may have, is it right? They can have different reporting dates. Is it different reporting dates? But at the time of consolidation, is it at the time of consolidation, it should be consolidation. They should have one report, same year. Is it? See, the only thing is, wait, what we have to come is, in the accounting, there is nothing like must, okay? Always, see, you have here must, you have here must. This is one of the indications. I'm not saying that must is one of the conditions. They will everywhere you will have some assumptions. Is it? There is no fixed rigidity. Is it? Everywhere they will have some limitations. Okay, fine. We will, the moment we will cover, we will have more exposure on this. Is it fine? Are you clear about this one?
Yes, Doctor. Yeah.
Fine. Is it okay, Hussein?
Yeah.